In Stacking Up today, Tom White of Red Options Advisors joins us to talk about some hot plays in the market, starting with J&J. A lot of traders have been talking about this stock because it's such a big dividend player, and yields are so low on the 10-year right now. So what do you like about this stock or don't like about this stock?
It's not that I dislike it. I just think it's kind of a little bit overvalued at this point. It's up almost 20% this year alone in 2016. And what we're seeing is, because the dividend yields are so low in treasuries, that we're seeing some flows into blue chips that pay a dividend. I think it pays about a 2.6% yield in the name alone, but the stock also is above that $120 level, and I think it's a little bit rich as far as valuation goes right here.
All right, so you would just kind of stand pat on that one, it sounds like.
Yeah, I think it's overdue for a pullback a little bit. The overall market's about flat for this year, and with the stock up 20%, it's getting a little bit rich as far as valuation. I think PE ratio is about 23 at this point, and I could see it going back to that, maybe between that $115 and $120 level.
And then that would be a better buying point for you?
Oh, definitely a better entry point. It's a good business, it's solid, but growth is still pretty low in there as far as year over year. So maybe that $115 to $120 range is a better price entry point for me.
Now, what about Pepsi, which came out with earnings today? What would be a long-term view on Pepsi?
Yeah, it's another one of those blue chips. It's stable, pays a great dividend. It's in the snack food and beverage business, unlike Coke, which is mainly focused on the beverage side, which has actually helped Pepsi over the last year. The stock's up about...
Snacks are selling.
Yeah, snacks
and they're trying
sell.
to get into healthy snacks, which is a good thing, compared to soda, which is down, right?
And I think that growth sector in snacks is a lot better than in beverages. It's actually pulling back, which is why Coke stock has been relatively flat, while Pepsi's kind of rallied a little bit more. That $106, $105 level in Pepsi, a little bit rich on valuation, but not bad considering all the other entry points or stocks that you could get into in this type of environment with falling yields. And there's still headwinds. The Brexit thing's not played out completely, but after earnings, guidance a little bit lower. I could see that stock pulling back into that $100 to $105 range. That should be a better price entry point, but you do have to look at their margins going forward.
Now, yesterday there were some big downgrades to the airline sector, and I know Delta is one of the names that you're watching. I saw some interesting paper in the options where people were reaching for puts, maybe near term, but longer term they were still buying calls. They're kind of dismissing this downgrade.
Yeah, I think there's going to be some people taking some shots in there over the next month or so. What we've seen is the stock pull back over 30% this year alone. Oil prices are starting to pull back a little bit, which should help. But what they did was they came out earlier this week. They guided their revenue per seat down about 5% year over year from June alone. That continues to decrease. Their competition ramps up, and their margins are getting squeezed a little bit more. We could see that stock fall a little bit further, but valuation in that name really low. They've got earnings on July 20th this month. That'll be a real catalyst for the shares going forward, as it's approaching that $33, $32 level, and that might be a good entry point there for a longer term investor, as those names in the airline sector have been beat up really quite a bit this year.
Well, thanks so much for your trader insight.